If you trade ODTE options, there's one skill that's far more important than chart patterns. Technical indicators, or your intuition. It's the ability to think like a quant. Because at the end of the day, the market doesn't care about our feelings. It cares about data, structure, and probabilities. And if you don't measure those things correctly, the market will take your money. Today, I am going to show you exactly how a quant approaches the market, the precise methodology I use in every single strategy, every experiment, and every backtest I run. Before we ever touch code or look at a single chart, a quant begins with a simple question. How can I measure what I believe? Not guess, not hope, not feel measure. Quants don't ask whether the market will go up or down. They ask, what is the distribution of returns? What does volatility look like intraday? What is normal movement versus abnormal movement? And how does the market behave in different regimes? This mindset is everything. It's the foundation of a durable, data-driven approach. And every single quant project starts with the same foundation, clean and reliable data. For us options traders, that means SPX and SPY price data, intraday data, whenever possible, volatility indices like VIX or VIX1D, and option chains. The rule is simple and unforgiving. Garbage data means garbage models. So, before any analysis begins, we have to check for missing days, incorrect timestamps, and whether our prices are aligned properly across different data sources. This is the unglamorous but absolutely essential bedrock of everything that comes next. If you skip this, you're building your entire trading strategy on sand. Once we have reliable data, we transform it into meaningful, tradable metrics. This is the step where quants derive things like returns, log returns, true range, expected move, volatility estimates, realized volatility, momentum filters, and regime labels. The goal here is to extract the hidden structure of price behavior. We all know markets are noisy, but they are not completely random. And this transformation step is where patterns finally begin to emerge from that noise. It is like putting on a pair of glasses that lets you see the underlying mechanics of the market. Before building any kind of model, we visualize everything, and I mean everything. Time series plots, scatter plots, histograms, regime charts, quantile analyses. These are the tools that reveal truths that raw numbers simply cannot. Visuals are incredible because they can expose outliers, clustering effects, regime shifts, and nonlinear relationships that are invisible in a spreadsheet. A single scatter plot can completely invalidate a trading idea before you waste weeks backtesting it. This step saves an incredible amount of time, money, and perhaps most importantly, it prevents false confidence built on flawed assumptions. From there, we move into building and testing our hypotheses. Every quant experiment follows the same exact path. You start with a hypothesis. You build a model to test it. You backtest it rigorously, and then you face the truth. For example, we might ask, does higher volatility consistently predict bigger intraday ranges? Do certain momentum filters actually reduce our drawdowns? Does the expected move accurately capture intraday risk? Are some days of the week consistently more volatile than others? Then we backtest these ideas using real data, real-world assumptions, and real constraints. No fantasy backtests where you get perfect fills and have no trading costs. We need to know if the edge exists in the real world. But here's a critical point. One backtest is never enough. We have to validate our findings across different time windows, different market regimes, subsamples of the data, and various stress scenarios. We test the sensitivity of our parameters. We compare our results against simple baselines, and we constantly challenge the assumptions we made. A model that only works in one specific dataset isn't really a model, it's just a coincidence. Validation is the step that separates a real, repeatable signal from random noise. It's the difference between a strategy and a lucky guess. Finally, a quant's job is to convert all of these insights into actionable decisions. This is where the rubber meets the road. It means building safer strike, placement rules, developing better filters to know when to stay out of the market, implementing smarter position sizing, and most importantly, knowing when not to trade at all. Good quant work transforms confusion into clarity. It gives a solid structure to your decision-making process. And it shines a spotlight on where the true risks are hiding, often in plain sight. This quant methodology I have just walked you through forms the foundation of everything I analyze and trade. It creates a repeatable system for understanding market behavior, a scientific way to evaluate ODTE volatility, and a consistent framework for discovering patterns that others might miss. Most importantly, it allows us to uncover truths that premium sellers simply cannot afford to ignore if they want to survive long-term. And in the very next video, we are going to use this exact quant process to answer a critical question for all ODTE traders. How well does the expected move actually predict the real intraday volatility? What we discovered was surprising, and it fundamentally changes how premium sellers should think about risk. You won't want to miss it. Thanks for watching, and I'll see you in the next one.